Okay, let's unpack this. You know, what I find really compelling about corporate finance is this inherent tension. We need precision in reporting, right? But then there's the whole question of how we actually validate it. So today our focus is mastering that core structure, the three main financial statements, and crucially, the high-stakes process designed to check them, the external audit. Let's start there. With the audit itself, what exactly is it? It's an official assessment done by professional accountants looking at a company's financial records. It gives stakeholders, investors, creditors, even regulators, that confidence that the statements are, well, accurate reflections of the company's financial health. Helps prevent fraud, ensures compliance, like with SEC rules for public companies.
Exactly. And let's be clear. An audit isn't about checking if the business is run perfectly. Not really. What we're looking for are material misstatements. Are the books presented fairly according to standards like GAAP? That's key. Because GAAP ensures comparability, year over year, company to company. The audit's goal is to validate the integrity of the big three: the income statement, the balance sheet, and the cash flow statement.
Right. So three different statements, all required. What's the functional difference between them? Why not just one?
Well, they offer three distinct views, but they're definitely interconnected. Think of it like different camera angles on the same subject. Let's start with the balance sheet. This is like your fundamental accounting equation. Assets equal liabilities plus shareholder equity. What's interesting here isn't just that it's a snapshot of worth, its book value, but it really reveals the company's capital structure.
Capital structure, meaning how they fund themselves?
Precisely. How much they rely on debt, which is the liabilities part, versus equity, which is shareholder equity, including things like retained earnings.
Okay, that debt versus equity piece is, yeah, immediately crucial for assessing risk. But the balance sheet is just a snapshot, right? What about performance over a period?
That's where the income statement comes in.
Hmm.
It covers a specific period, like a quarter or a year. It details revenues earned against the expenses incurred to arrive at the bottom line, net profit or loss. You track things like gross profit, that's after your direct costs, all the way down to net income, which is profit after interest and taxes are paid. Basically, the company's profitability report card for that period.
Okay, makes sense. But the income statement uses accrual accounting, doesn't it? So revenue is booked when earned, not necessarily when cash comes in.
That's right.
So if cash is really king, how do we see the actual cash movements?
That's the cash flow statement's job. It bridges that gap between accrual accounting and, well, cash reality. It tracks the actual inflow and outflow of cash, breaking it down into three core activities. You've got cash from operating activities, day-to-day business. And yes, net income is usually the starting point there. Then, investing activities, think big purchases like machinery or buildings. And finally, financing activities, how the company raises capital, like issuing debt or stock or paying dividends.
Got it. So three statements, three different but connected views. Now we know the basic architecture. The next step is using them, right? Turning those numbers into actual financial decisions. And that means analysis. There are three main ways we tend to do this. First, horizontal analysis. This is where you compare line items across different myriads, like comparing this year's revenue to last year's. Helps you spot growth trends or maybe worrying declines. Did revenue go up 10%? That's horizontal analysis. Then there's vertical analysis. This looks at proportions within a single period. So you express everything as a percentage of a key figure, like what percentage of sales is the cost of goods sold. Helps gauge efficiency.
Right, comparing parts to the whole. And then, often most critical for stakeholders, is ratio analysis. This is where you calculate statistical relationships between different numbers, often pulling from multiple statements. A classic example is the debt-to-equity ratio. Uses figures right off the balance sheet. Tells you about financial leverage, how risky the company's financing is.
Okay, so these analyses give us insights.
Exactly. They tell the story hidden in the raw numbers. But, and this is the crucial link back with the credibility of all that analysis, it hinges entirely on the audit. The gold standard output from an audit is what's called an unqualified opinion. Some call it a clean opinion. It basically means the auditor believes the financial statements present the company's position fairly in all material respects, following the relevant accounting standards like GAAP.
So that clean opinion is what gives investors and lenders the confidence to rely on those numbers and the analysis derived from them.
Absolutely. It boosts confidence significantly, globally even.
So what does this all boil down to for you, especially if you're studying finance? Audits aren't just some regulatory hoop to jump through. They're valuable business tools. They validate the data you'll use for risk assessment, for valuation, and they can even uncover operational weaknesses. But here's a final thought to chew on. While everyone aims for that unqualified opinion, the process itself has limitations, doesn't it?
It does. Audits provide reasonable assurance, not absolute certainty.
Right. They rely heavily on sampling data, not checking every single transaction, and professional judgment by the auditor. So it raises an interesting question. Given that reliance on sampling and judgment, how much faith should stakeholders really place in a clean opinion when it comes to detecting perhaps smaller errors, ones that aren't immediately material but might signal underlying control issues?
That's a complex question.
Definitely something worth considering as you start analyzing real world corporate financials.